Welcome back to the Business from Scratch podcast. I'm your host, Abby McGee. And today we are talking about something that I have personal experience with and some personal regret about. We're talking about payment processor loans, Square loans, PayPal Working Capital, Shopify Capital, Stripe Capital, whatever your payment processor offers. These products have become incredibly common for small business owners, and I understand exactly why. I've taken a few of them myself. And I'm going to be upfront with you. This is not going to be a purely cautionary episode where I tell you these are evil and you should never touch them. That's not the full truth, and we don't do half-truths on this show. There are situations where these loans can make sense, but there are also situations where they will quietly drain your cash flow, mess with your ability to budget, and leave you wondering how something that felt like a lifeline turned into a weight around your neck. I've been in both situations. So today we're going to talk about how these products actually work, what they cost you in real terms, when they make sense, when they don't, and what your better options are when you need capital. So let's get into it. You're listening to Business from Scratch, the podcast for people building businesses they love without losing themselves along the way. I'm your host, Abby McGee. Let's get started. First, let's be precise about what we're talking about because these products are often marketed as loans, but they're technically something slightly different. Most of them are structured as merchant cash advances, which means the lender is essentially buying a portion of your future sales at a discount. You get a lump sum today, and in exchange, they take a fixed percentage of your daily sales until the total is repaid. And here's what that actually looks like in practice. Say you take out a $10,000 advance. Instead of an interest rate, you're charged what's called a factor rate, which is typically somewhere between 1.1 and 1.5, depending on your business history and the lender. At a 1.15 factor rate, you're agreeing to pay $11,500 total. That $1,500 is not an annual rate. It's a flat fee regardless of how fast you pay it back. If you repay that advance in 6 months, which is common, your effective annual percentage rate climbs significantly higher than that flat percentage suggests. Compare that to a typical SBA loan rate of around 8.5%, and you start to see the real cost of the convenience. And that brings me to the piece that tripped me up personally, the daily holdback. Instead of a fixed monthly payment you can budget for, these products take a percentage of your sales every single day. On a strong revenue day, a big chunk comes out. On a slow day, less, but it still comes out. On the surface, that sounds almost fair. But here's why this scenario can get you into real trouble. On your slow days, that money coming out is often the cash you needed the most. There is no predictability. There is no fixed number to build your budget around. It just comes out every day, automatically, and you feel it most exactly when your business can least afford to. That was my experience every time. And I want to show you exactly what that looked like with real numbers. Let me show you what this actually looks like because I've lived this with Salt and Charm, and I think seeing the real numbers is more useful than any hypothetical I could construct. Back in October of 2024, I took a $30,000 Square loan. The factor rate was 1.15, meaning I agreed to repay $34,488 total. The cost of borrowing that $30,000 was over $4,000, a flat fee. 15% of the loan amount. That $4,488 didn't come out in a tidy monthly installment I could plan around. It came out automatically every single day as a percentage of my daily Square sales for 189 days, 6 months and change. I think it was around like 169 separate transactions or days that we had sales to subtract payments from. Some days the automatic payment was $450. Some days it was less than $1. The average daily automatic payment over that entire period was about $136. There was no fixed number, no consistent amount, just Square reaching into my account every day and taking whatever the formula calculated based on what I'd processed. So every single month, over $3,000 coming out of my cash flow in unpredictable daily increments before I ever touched a dime of my revenue. In February and March alone of that year, over $4,000 each month. That is real money with real impact on what I could do, what I could pay, what decisions I could make. And here's the number that puts it all in perspective. If I had taken that same $30,000 as an SBA loan at 8.5% over the same 6-month period, the total cost of that money would have been approximately $780. The Square loan cost me $4,488. That is $3,700 more just for the convenience of clicking a button in my dashboard. Was it worth it? That's a question only I can answer based on what the capital did for the business at that moment. But now you know what you're actually paying for. So if they're expensive and unpredictable, why does anyone take them? Because they are extraordinarily easy to access. This episode is supported by Salt and Charm, the business I built long before this podcast ever existed. We offer luxury private chef experiences, full-service catering, and curated weekly meal prep delivery in Wilmington and surrounding areas. Salt and Charm is where I've learned the lessons I share here about resilience, leadership, growth, and building something that doesn't run your life. We believe hosting should feel joyful and everyday meals should feel intentional. If you're in Wilmington, Hampstead, Wrightsville Beach, or Brunswick County, we'd love to serve you. Visit us on Instagram at Salt and Charm and on our website at saltandcharm.co to learn more. And just for our listeners here on the podcast, get $10 off your next meal prep order by using code PODCAST at checkout. Every week, we feed hundreds of people at their dinner tables, and we would love to help make your week a little less stressful and a lot more delicious. If you process payments through Square or PayPal or Shopify, they already have your entire transaction history. They know your revenue, your seasonality, your average ticket, your busiest months. They don't need you to pull out a lengthy application or provide years of tax returns or sit across from a banker and make your case. They just offer it to you, often proactively, right there in your dashboard. One click, funds in your account, sometimes within hours. When you're a small business owner and you need capital fast, for things like equipment, inventory, for a marketing push, or payroll during a slow month, that one-click accessibility is genuinely seductive. I get it. And that ease is by design. These companies have built a product that removes every possible point of friction between you and the money, which is great for them, and it's not always great for you. The speed and accessibility also means that a lot of business owners take these advances without fully understanding what they're agreeing to. You're not sitting across from a banker who walks you through the terms. You're clicking through a dashboard. And the total cost of that money and what it will feel like coming out of your account every day often doesn't fully land until you're already in it. But let's be fair, because there are situations where these products are a legitimate good tool. When you need capital extremely fast and the opportunity is time sensitive, like if you have a large booking event, a bulk inventory purchase, or a piece of equipment that needs to be replaced immediately and waiting 3 to 4 weeks for a traditional loan approval isn't an option, a payment processor advance can bridge that gap. The cost of missing the opportunity may genuinely be higher than the cost of the advance. When you have strong, consistent, predictable revenue, if your daily sales are stable and you know your floor or what your slowest days look like, you can model out what the daily holdback will actually feel like before you take it. If the math works and the cash flow impact is manageable, it's a real option. When the amount is small relative to your revenue, like a $5,000 advance on a business doing $50K a month in revenue is a very different proposition than a $30,000K advance on a business doing only $15,000 a month. Size it to what your revenue can comfortably absorb. We're going to talk about some alternatives in a minute, but if you've genuinely looked and the timeline or qualification requirements don't work for your situation, a payment processor advance may be the practical choice. The key in all of these scenarios is going in with your eyes open. Know the factor rate, know the holdback percentage, model out what your daily repayment will look like on your average day and on your slowest day. Make sure you can live with both numbers before you click confirm. Now, when do they not make sense? when you need it because cash flow is already tight. This is the most common trap and the most dangerous one. When you're already stretched, the daily holdback makes a tight situation even tighter. You're essentially borrowing from tomorrow to pay for today, and tomorrow's sales are already spoken for before they hit your account. I've been in this cycle, and it is hard to get out of. When you're taking a second advance to manage the first one, if you find yourself looking at a new advance offer because you need to cover the gap created by the current one, stop. This is a debt spiral in early formation. It needs to be addressed differently, not papered over with more expensive capital. When a lower cost option is available and you just haven't looked, this is the one I want to spend the most time on because I think a lot of business owners default to the payment processor advance, not because it's the best option, but because it's the easiest one to find. There are better options, so let's talk about them. Number one, SBA loans. The Small Business Administration offers several loan programs, the most common being the 7A loan with interest rates that are significantly lower than merchant cash advances. The trade-off is time and paperwork. SBA loans require documentation, a solid credit profile, and can take several weeks to close. But if your need isn't immediate, the cost savings are substantial. For a business with a track record, this should always be the first call you make. Next, a business line of credit. A business line of credit through your bank gives you access to a pool of capital that you draw from only when you need it and pay interest only on what you use. This is one of the most flexible tools in small business finance and vastly underutilized. It gives you predictability with a set interest rate, a set repayment structure, and it doesn't take a percentage of your daily sales. If you don't have one of these established yet, go talk to your banker this week, like for real, like go now. And then a small business credit card can be used strategically. A business card with a 0% introductory period can be a legitimate short-term capital tool if you're disciplined about paying it down before the rate kicks in. They are not for everyone and not for every situation, but worth knowing as an option. And then there's revenue-based financing from dedicated lenders. If the merchant cash advance structure actually works for your business model and you just want better terms, there are dedicated revenue-based financing companies separate from your payment processor that often offer more competitive rates and better terms than Square or PayPal. Shop it. Don't just take what your processor offers because it's right there in your dashboard. And also, your existing banking relationship is valid. This is one of the most underused of all. If you have a solid banking relationship and a business with a real track record, go have the conversation. Banks want to lend to healthy small businesses. A lot of business owners assume they won't qualify or that it's too much hassle and they never ask, but you should ask. So, the takeaway from today is payment processor loans are not inherently bad. They are a tool like any tool. They can be used well or used badly, and the difference is almost always whether you fully understand what you are agreeing to before you sign up. I ran the real numbers from my own Square loan for this episode, and even I was struck by how clearly the math laid it out. $4,488 in fees versus $780 for a comparable SBA loan. $3,700 is the price of convenience and speed. Sometimes that price is worth it, but you should always know what you're paying for before you pay it. Know your factor rate, know your holdback percentage, model the daily impact on your cash flow before you take the money. And before you click that button in your dashboard, spend 30 minutes asking whether a better option is available. Sometimes it isn't, but a lot of the time it is. And 30 minutes of research could save you thousands of dollars and months of cash flow stress. I've learned this the hard way, so you don't have to, or at least so you can go in with your eyes open. I'm Abby. Thank you so much for tuning in and listening today. Thank you for subscribing and sharing the podcast with others. It means so much to me and is how this show grows and makes a difference for other small businesses. Join us every Tuesday for a new episode, and we will see you next week. Thanks for joining me on Business from Scratch. Follow the show for more honest conversations about building a business that works for you.